Last month, I opened my credit card app to pay my bill. Before I could do anything, a pop up jumped on the screen. It said, "Update your income so we can serve you better." There was a little form. My old salary was already filled in. All I had to do was type in my new number and hit submit. Serve you better. That's what they said. I closed it. Didn't type a single digit. Because I know exactly what that pop up was really about, and it had nothing to do with helping me. Here's the thing most people never think about. When you hand a bank your income number, you're not doing them a favor. You're giving them a weapon. You're loading a gun that they will point right at your wallet, and you won't even hear the shot. Every time you update that little income field, something happens behind the scenes. Algorithms kick on. Numbers start running. Your profile gets quietly resorted in ways you'll never see, but you will feel. Banks have gotten so good at making income questions feel normal, feel routine, feel expected, that most people never stop and ask the one question that actually matters. Why do they want this number? And what exactly do they do with it once they have it? The answers to those two questions might change the way you deal with banks for the rest of your life. Let me tell you something that might actually annoy you a little. Banks don't have to ask for your income. There's no law that says a credit card company needs to know your salary. No rule requires your bank to keep your income on file. None. Zero. They ask because they want to, because knowing your income helps them make more money from you. That's the whole reason. This is a big deal. When something is legally required, you have no choice. But when something is just a request dressed up to look like a requirement, you have options. Banks work very hard to blur that line, because customers who know they have options make choices that cost banks money. Think about the last time you filled out a credit card application. There was an income field. You filled it in. Of course you did. It felt like part of the process, like giving your address or your date of birth. But the second you hit submit, something happened that you never saw. The bank system instantly sorted you. That one number became a label. And that label started making decisions about your financial life. Not just whether you got approved, but what interest rate you'd pay, how high your credit limit would be, what ads you'd see, and how hard they'd try to sell you other products. All from one number you gave them without thinking twice. The most obvious thing banks do with your income is decide your credit limit. Bigger income, bigger limit. Simple enough, right? On paper, it makes sense. Someone bringing home $150,000 a year can probably handle more credit than someone bringing home $50,000. But here's what they don't tell you. A higher credit limit isn't always good for you. It's great for them. When your limit goes up, you tend to spend more. You accumulate more debt. You pay more interest over time. Banks have studied this. They know that people with higher limits carry higher balances on average. A $30,000 credit limit doesn't just mean you can spend more, it means you probably will. They're not giving you a high limit as a prize for earning well. They're giving you a longer leash because they've noticed that customers with longer leashes tend to walk themselves right into interest payments. Your high income doesn't make them generous. It makes them see opportunity. Here's where it gets a little wild. Most people assume that if you earn more, you get better interest rates. Lower risk, better deal. Makes sense, right? Not always. Banks don't just use your income to measure how risky you are. They use it to figure out how much they can charge you before you get fed up and leave. Someone earning $200,000 a year probably isn't going to spend a Saturday afternoon shopping around for a credit card with a slightly lower APR. They might not even notice if their rate creeps up a few points. The bank system knows this, and it prices accordingly. There's actually a name for this inside the banking world. It's called ability to pay pricing. It means the more you can afford, the more we'll charge. Not because you're a bigger risk, but because we think we can get away with it. Studies have found that wealthier customers sometimes end up with worse loan terms than they deserve, simply because the bank correctly predicted they wouldn't bother pushing back. Your high income in this case is working against you. It's a signal that says this one won't fight us on price. Once the bank has your income, the sales machine turns on and doesn't turn off. High earners get bombarded with pitches for premium credit cards with giant annual fees. They get offers for personal loans, investment products, insurance packages, and travel rewards programs that cost hundreds of dollars a year just to hold. Every time you log in, there's another offer waiting, carefully chosen based on the income bracket you placed yourself in the moment you filled out that form. Banks know that someone pulling in $180,000 a year is more likely to say yes to a $550 annual fee card than someone making $60,000. They also know that higher earners usually have more complicated financial lives, which means more chances to sell them more things. Lower earners don't escape either. They just get a different menu. Less premium, more predatory. Balance transfer deals with sneaky fees buried in the fine print. Personal loans at painful interest rates. Credit limit bumps designed to get them spending more than they should. The targeting is just as precise. The goal is the same. Only the products change. Your income data isn't sitting quietly in a database somewhere. It's working a 24-hour shift trying to separate you from your money. Here's the part that most people never think about, and probably should. When you give a bank your income, that number doesn't just get used once and deleted. It lives in your file. It gets referenced for decisions made months or even years later. It gets shared with affiliated companies and partners in ways that are technically allowed under privacy policies most of us have never actually read. That income figure you typed in 5 years ago might still be quietly shaping how the bank treats you today. It could be part of the reason your interest rate went up, or your credit limit quietly dropped during a rough stretch in the economy, or why you suddenly started seeing a different set of offers in your app. Banks have very long memories. The data you hand them has a long shelf life, and the older it gets, the less you think about it. But the algorithm never stops thinking about it. So when do you actually have to share your income, and when can you say no? Mortgage applications require it. This is federal law. Lenders must confirm you can repay the loan. You'll hand over pay stubs, tax returns, employment letters. There's no way around it, and honestly, you wouldn't want there to be. Lending money for homes with no income verification is exactly what helped blow up the economy in 2008. Auto loans usually require income disclosure too, though how strictly lenders verify it varies from place to place. Credit cards are a different story, and this is the part that surprises most people. Credit card companies ask for your income, but they almost never verify it. They can't see your tax returns without your permission. They can't pull up your pay stubs. They're working entirely off whatever number you give them. Think about what that tells you. Banks want your income number badly enough to ask every single time, but not badly enough to actually check if it's true. That says a lot about how they're really using it. And those income update pop-ups that show up on your account? Completely optional. There is no rule that says you must update your income mid-relationship with a bank. They want it, they don't need it. The pop-up is designed to look like a requirement while being nothing of the sort. Let me be completely clear about one thing before we go any further. I am not telling you to lie. Writing a false income on a credit application is fraud. It is illegal. It is genuinely wrong. Don't do it. Full stop. What I am saying is something very different. There is a big gap between lying and simply choosing not to share. When a bank sends you an income update pop-up in the middle of an existing relationship, you are allowed to close it. You're allowed to leave the field blank. You're allowed to say no. That's not deception, that's privacy, and it's yours to exercise. Think about how uneven this relationship really is. The bank knows your spending patterns, your payment history, how much debt you're carrying, when you pay late, and what kind of purchases you make. They run all of this through systems you'll never see to produce decisions you'll never fully understand. Meanwhile, you know almost nothing about how their algorithms work or how your data is being used. Choosing not to hand over one more piece of information doesn't make you dishonest. It just makes the playing field slightly less tilted against you. Picture two people. Same credit score, same spending habits, same payment history. near identical files in every way that matters. The first person updates their income every time the pop-up appears. Their salary has grown from $70,000 to $95,000 over 3 years, and the bank knows it. Their credit limit has been bumped up twice without them even asking. Their inbox is full of premium card offers and personal loan pitches. The algorithm sees a rising income and smells opportunity. The second person filled in their income on the original application and never touched it again. Same real-world salary growth, but the bank doesn't know. Their limit is the same as the day they open the account. The offers they receive are standard. They fly completely under the radar because there's nothing fresh for the algorithm to work with. Which customer is better off? It honestly depends on what you want. If you want the highest credit limit possible and don't mind being marketed to constantly, keep everything updated. But if you'd rather be left alone, keep your terms stable, and avoid being endlessly upsold, staying quiet might be the smarter play. Here's a scenario most people don't think about until it's too late. When the economy gets shaky, banks go through their customer lists and start making cuts. Credit limits get slashed, accounts get closed, interest rates get raised. These decisions are made by algorithms, and income data feeds directly into them. A customer with a high reported income might keep their credit limit intact. The algorithm figures they'll keep paying. But that same high income might also make them a target for steeper rate increases, because ability to pay pricing suggests they'll absorb the hit without switching banks. A customer with lower reported income might face preemptive limit reductions. The algorithm flags them as higher risk during uncertain times, regardless of whether they've missed a single payment in their life. The only real protection against being sorted this way is giving the algorithm less to sort. The less income data the bank has, the more it has to rely on what you actually do: your payment record, your utilization rate, how long you've had the account. Behavior is harder to manipulate than a number in a form. And if your behavior is solid, that record will protect you better than any income figure ever could. I know someone who learned this the hard way. She worked as a contractor. Her income moved around a lot, sometimes $8,000 a month, sometimes $15,000, depending on the projects she had lined up. When she applied for a credit card, she reported her income conservatively, using her slower months as the baseline. 2 years went by without any issues. Then the bank sent her a credit limit increase offer and asked her to update her income to process it. She entered her current earnings, significantly higher than what she'd originally reported. Within 3 months, everything changed. Her phone started ringing with personal loan pitches. Her card offers completely shifted to high-fee premium products. Her mailbox filled up with balance transfer promotions designed to get her into debt. She had been quietly reclassified. What used to be a calm, simple banking relationship turned into a relentless sales campaign. She never updated her income again after that. Every pop-up got closed immediately. Within about 6 months, the calls slowed down, the offers changed back, and things returned to normal. The algorithm had stopped receiving fresh information, and without fresh data to work with, it gradually lost interest. That story reveals something important about how bank data systems work. They're built to run on fresh information. Old data is less useful because it's less accurate. A 3-year-old income figure doesn't trigger the same response as one you entered last week. Banks know this. It's why they keep asking for updates. Every time you provide a fresh number, you restart the process. You become a newly sorted target. The system wakes back up and starts working on you again. But, and this matters, there are real situations where sharing your income update is the right move. If you want a higher credit limit and your income has genuinely grown, providing that information can make your case. If you're applying for a loan and a higher income improves your shot at approval, sharing it serves you. The goal isn't to withhold forever. The goal is to be intentional. Share when it helps you, stay quiet when it only helps them. That's the whole strategy. Banks also calculate something called lifetime value, an estimate of how much profit they expect to earn from you over the entire relationship. Income is a major piece of that calculation. The less they know, the harder it is for them to optimize against you. Uncertainty in their model usually leads to more cautious, more neutral treatment, which tends to work in your favor. Here's what to actually do with all of this. When you apply for a new credit card, you'll need to provide income. It's part of getting approved. Just be thoughtful. If your income varies, you don't need to use your best month. If you have multiple income sources, you don't have to include every single one. Report honestly within those boundaries, but don't volunteer more than the question requires. When an income update pop-up appears on an existing account, close it. There is no penalty. It will come back. Close it again. Your account will not be affected. Your credit score will not change. The bank simply won't have what it was fishing for. When you get a credit limit increase offer and you don't actually need a higher limit, decline it, and don't hand over income data to enable an increase that only benefits the bank. When income verification is genuinely required for a mortgage, a car loan, provide exactly what's asked and nothing more. If a lender requests documents beyond what's legally required, ask why before you hand anything over. When a bank calls asking you to update your information, remember, phone calls are designed to create a feeling of urgency. You're allowed to say no. The call will end. Your account will remain open. The bigger picture here goes beyond banking. Any institution asking for your data is collecting it for their own purposes, not yours. The framing might be better service or improved experience, but the real goal is building a more accurate picture of you so they can extract more value from the relationship. Data minimization is a legitimate, sensible way to protect yourself. Give what's required, hold back what's optional. Banks aren't the enemy. They provide real services, credit cards, loans, savings accounts, that most of us genuinely need. But they are also businesses built to profit from their customers, and they treat your data as a resource to be used. Understanding that dynamic isn't cynical, it's just clear-eyed. So the next time that little income update pop-up slides onto your screen, you'll know exactly what it is. The bank wants a fresh number to feed into systems designed to get more money out of you. Not to help you, not to serve you better. Close the pop-up. Let your payment history do the talking. That's the one piece of data they can't just ask you for, and it's the only one that truly tells the story of who you are as a customer.